Very interesting reading because from a portfolio management perspective, from an investment management perspective, if you can time your entry and exit into the market, you can, of course, generate more returns than others. And this is something that you're going to build on throughout your CFA journey. Even in level three, when you're studying capital market expectations, this is something that keeps getting enriched over the three levels. And even after your CFA journey, probably through channels like Bloomberg and CNBC, you keep in touch with what's going on in the monetary policy and in the fiscal policy and overall in the economy to try and figure out where we are in the business cycle, because stock market returns, bond market returns are highly dependent on what goes on in the business cycle. So what we are going to get into is first an overview of the business cycle. How does the credit cycle link with the business cycle? And how can we as analysts study economic indicators to try to predict what's going to happen next in the business cycle? So that's the mindset you need to develop right now, is that what is the objective for us to study this? We want to get to know these economic indicators that are useful in predicting the future of an economy, because we want to invest in the assets which are expected to go up in prices, right? So to be able to do that, we need to know what is a business cycle, what are the different phases. Clearly, we don't want to be investing when it's going down. How does the credit cycle affect the business cycle? So what is their relationship? And regarding these indicators, there are various types, right? You can analyze the use of resources, the amount of capital spending, the inventory levels. This, by the way, is a very important one, and we'll talk about that. But we're going to look at all the ones, and then, of course, some we will talk about a little more than others because they are very useful in helping us predict the future. Right. So, first of all, let's start with the definition of a business cycle from our curriculum. And it says business cycles are a type of fluctuation found in the aggregate economic activity of nations that organize their work mainly in business enterprises. Now, I think we need to emphasize on this word. So, if you have a country which is purely agricultural in nature, they may not have that much of a contraction and expansion compared to economies which have a large sector which consists of business enterprises. Number one. Number two, a cycle consists of expansions occurring at about the same time and in many economic activities. So let's stop here and let's talk about this same time for a moment. Actually, it's not really same time, it's just more of a domino effect that one happens after the other, but they just happen together. And let me give you a practical example. So let's say the banks are giving out loans to people to buy houses, and people are also buying houses because they're doing well at work and everything is going well, the economy is growing, everyone's getting a salary increase, the company's sales are going up. And then what happens is the cycle turns, and then the banks start pulling the financing, the demand for housing goes down. And notice how I talked about the banks, because there's definitely a link between the business cycle and the credit cycle, and we'll talk about that later. But just for now, I want you to focus on what happens when the housing demand goes down. people in the construction sector, they lose business, right? Because the new construction probably slows down. And then when they lose their business, they lose their jobs, they probably stop buying new cars and buying other consumer durables. They probably postpone the purchase of large purchases that they were planning to make. So it just has this trickle down effect, and then the entire thing sort of just slows down until you get to that stage where you start reviving and then get into the next expansion phase. But what I want you to keep in mind is that there's definitely a big link between the business cycle and the credit cycle. So banks have a huge role to play. And what we will see later on is that how the credit cycle sort of makes this whole thing worse, right? Um, and why am I saying worse is because actually what happens is, let's say if I put a chart over here, and let's say this is time and this is the GDP of a country. Now, nobody's saying that the GDP stays constant. That's the first thing we need to understand, that already the GDP is increasing. There is a long term trend growth rate, right? And this is how your country's GDP is growing at a slow, stable, long term rate, which depends on the labor growth, the capital deepening, and the total factor productivity, or the technological factor, which is discussed in a separate learning module. But the problem with the business cycle is that it sometimes it grows too fast. Now, if this is the normal growth rate and look at the difference in the angle, the trajectory is completely different, right? So the cost of growing too fast is that it's not sustainable. Then what happens is that this trough, and then unfortunately everything gets little disturbed, people get depressed, they stop their spending, companies stop expansion, they let go of employees, and then they realize, oh, we've let go of too many employees, so they have to hire some back again, and then again the whole thing starts. So this whole process of expanding too much and then contracting too much, it's painful, because imagine people lose their jobs unnecessarily, right? When they get hired again. So why go through that pain? And the credit cycle definitely makes it worse. But what the government policy should be is, and it is, of course, to try and smooth this out. So when it's overheating, let's say when it's overheating over here, what they would do is try and increase the interest rates to kind of slow it down. And then when it's kind of in a recession over here, they will try and stimulate it with lower interest rates and more money supply, so that this whole painful process kind of becomes lesser in terms of the level of the peaks and troughs, and also in terms of the duration. So which brings me to the level of the peaks and troughs and the duration, that it's not necessary that it looks exactly the same for each cycle, right? What you could have is, maybe before you had bigger peaks and bigger troughs, but now we have smaller peaks and smaller troughs, right? So maybe we're kind of being able to actually fine tune this, number one. And maybe the peaks were longer and the troughs were longer, and now what we have is shorter peaks and even the duration is shorter, right? So that's what is said in this last part, which I've also made bold for you, of this definition, is that the sequence of events is recurrent. I mean, it does happen again and again, but it's not necessary that the duration of one cycle, right, is the same as the next cycle. So you can have a shorter cycle, you can even have a longer cycle, and it's also the intensity can be smaller as well. So when we say that they are not periodic, that's a reference to both the duration and also the intensity, right? So it could be as short as 1 year or as long as 12 years. There's a very nice research that is there in the curriculum for level 3 in the section of capital market expectations, where they actually take all these past business cycles and they really analyze them really well. So I hope you get to that level soon and go through that research because that is really interesting. Anyways, so back to level 1 and the overview of the business cycle. So again, as already discussed, that these happen where there are large number of private companies and not just agricultural economies, right? And the whole point is to see that cyclical behavior between expansion and recession. And why we are most interested in this is because as financial analysts, as portfolio managers, financial advisors, we need to make the best investments and generate the best returns on our investments. And we'll only be able to do that if we can time the market as best as possible, which of course means trying to get an understanding of where we are in the business cycle and trying to predict what happens next. Right. So coming back to the overview, and I said this is kind of like a domino effect, right? So it's pervasive. It's not just in one sector. It might start in banking and real estate where they start giving the loans and they ease the condition for the loans, and then the real estate picks up, and then the construction sector picks up, and the next thing you know, car sales are going up, durable sales are going up. So the expansion happens all together, then the contraction happens all together throughout the economy, one after the other. They are recurrent but not periodic, right? So the cycles do repeat, but the intensity and duration differs, right? So let's say, for example, the economic boom from 2002 to 2007 was 5 years. But then does that mean the next one will be for 5 years or more or less? Nobody knows, right? And then you have this huge variation from cycles as short as 1 year to as long as 12 years. So that is definitely a big difference. Now, guys, things are getting interesting. So how do we know where we are in the business cycle? And I'll just shortly prove to you that the most important way for us to analyze the phase of the business cycle is through the growth rate cycle. But first, let me talk about the classical cycle. Now, let's say if this is your time and this is your GDP, and the GDP is going up, right? Does that mean you're in an expansion phase? Necessarily, not necessarily, because maybe you're just growing, right? Not growing more than your potential, just growing. So there is a difference between growing and growing more than your potential. So the classical cycle actually just shows you what you're doing, just in absolute basis. But then if I put that trend growth rate, my long term trend growth rate, and why is that important? That's important because it shows me my potential as an economy, that this is my rightful level of growth, right? This is what I can organically keep sustainably growing. And then if I see my growth cycle, right, and then I'm able to say, oh, I'm actually growing faster than what my long-term sustainable growth rate is. So I know that this is something dangerous because it's not sustainable. It's going to stop. But if I'm just measuring that distance, let's say first my economy was at this point, let's say we were at 10 trillion, right? And then we get to, let's say, 15 trillion. But here, I've actually, so the economy has, let's say, let's not call it 15, let's call it 11, and let's call it 12. So the economy has grown by 1 trillion more than its potential, right? It should have gone from 10 to 11. It should have gone from 10 to 11. So this is just time, of course, right? So let's say this is 20, uh, 2000, and just taking some random numbers, and let's say this is 2020. So in these 10 years, the economy should have just grown from 10 to 11. But if it has grown from 10 to 12, that means it has grown more than it should have. And if I'm just measuring this absolute difference between the potential and the reality, that doesn't really tell me that have I peaked out in terms of creating that difference, right? Am I slowing down or not? So that's where the third one comes in, which is the growth rate. And when you monitor the rate, you see if the rate is slowing or not. So if the rate is slowing down, right, which means you were having that difference between the potential level of the economy and the reality increasing, but then you start seeing that that rate is actually not increasing anymore. Before it was increasing at a faster rate, but then it slows down, and then eventually obviously it turns around. But before it even turns around, we need to be able to predict that, right? Once it starts slowing down, so it's that rate of increase, the speed, that we need to compare. And it's like you throw a ball into the air, right? Obviously, it's going to slow down before it starts coming back down. So you need to see what is the speed at which it's going up. And that speed is going to slow. Before it stops and then starts coming back down, it's going to slow down. And that's what we need to monitor. So that's why the growth rate cycle is the best way to actually analyze this, right? So the classical cycle is just the actual amount of GDP. Just because it's growing does not necessarily mean you're in expansion, right? So that's where you get into the growth cycle, where you compare your growth with your potential growth level, and you see the difference. Now, if there is a positive difference and that difference is increasing, that means you are expanding more than your sustainable level, more than your potential level, but it's still not telling you that are you expanding at a faster rate or are you slowing down your rate. And that is where we get to the growth rate cycle, and this is the best one, because the advantage of this definition is that you just, instead of getting into the details of the long run growth path, all you have to do is you have to compare the rate, right? So the growth rate of this and with your normal sustainable growth rate. And if you feel that your growth rate is above the potential growth rate, that means you're in that expansion or upswing. And vice versa, if you're below the potential growth rate, that means you're in a downswing. And it can really help you sort of time your predictions that, okay, when are we going to now just slow down and slow with the upswing and then possibly start moving back down, right? So using this technique, you can actually recognize the peaks and troughs earlier compared to the other two techniques that we discussed before this. Right. Now, in your curriculum, the four stages are shown through this exhibit. And it's sort of a horizontal way where they're showing that, okay, this is the peak, and then it slows down and then goes into the trough, right? So when you're coming out of the trough, there's a recovery. And then, so here, the difference between your actual GDP, right? So this is, let's say, your actual GDP, and this is your trend GDP. So there is a difference, but then that difference starts becoming small. This is a shortfall. You're actually less than what your potential is. And then you become more, then the actual becomes more than your potential, and that's not sustainable, and then it comes back down, right? So the recovery brings it back to potential, but then it goes above potential through the expansion, and then obviously it has to slow down, and then it comes back to potential. The way I want you to see this is like this, because I mean that's what the reality is, right? I mean, if you just say that this is time, because the economy is growing anyways, and this is GDP. Especially, I mean, if you're measuring this in nominal terms, so with the money supply and everything, so in nominal terms, the economy's size grows anyways because we print money. But if this is your normal trend growth, right? If this is your trend growth, which is your potential level. So when you're in that trough, when you are in that trough, what happens is you are below potential, right? And then in the recovery stage, you just come back to your potential. So the trough actually brings you back to potential, which is your level, your rightful level where the economy should be. But then the expansion takes you above it, right? The expansion takes you above it, and then naturally that's not sustainable because you can't grow faster than what is sustainable for you. So eventually you start slowing down, and then you come back to your potential GDP or whatever is the rightful level for the economy. And this cycle continues, right? So that is your 4 phases of the cycle. Now, during these phases, what happens? Right? During these phases, what happens? Especially what we're most interested in is what happens to stocks and bonds, prices of stocks and bonds. But before we can talk about the prices of stocks and bonds, what we have to talk about is what happens to the economy and economic activity, because that helps us predict where we are. So let's say again with the GDP growth rate, long term trend, and let's say you are coming out of the trough. So this is your recovery. Now in your recovery, your consumers and your businesses start picking up their activity, right? So consumers start buying, businesses start spending, and that is a good indicator for you to monitor. And we'll talk about leading indicators, right? So some of the indicators are actually leading, some indicators are coincidental, which means they happen when the cycle is turning. Some indicators are lagging, such as inflation. So we'll talk in detail about all the different indicators and which ones are leading, which ones are coincidental, which ones are lagging. So that we can focus on the leading ones, obviously, and then confirm whatever our expectation is with the coincident ones, and then of course with the lagging ones later. But we need to first understand why these indicators do what they do. So let's try to understand the logic behind all of this. And when you're in the recovery, you've actually fallen way below the potential of your GDP. And the economy starts realizing that. Businesses start realizing that, oh, we fired these people unnecessarily. We actually need them. So they start hiring them back. Consumers who've been putting off spending for a while can't put it off anymore, and they realize that, oh, things are actually not that bad, and they can afford to buy that fridge, right, that refrigerator, or they can afford to buy that car. And then obviously there's definitely a big impact of the credit cycle here, because then what happens is that the government lowers the interest rates, the Federal Reserve lowers the interest rates, and the money supplies increase, and therefore the banking credit cycle starts to pump in money, starts giving loans, which again kind of stimulates the consumer spending, which then pushes up the business spending. So definitely there is a link between the business cycle and the credit cycle, and we will get to that. But when you do fall below your potential GDP, eventually the recovery starts. And for us to know that it's starting, what we can look at is the consumer and business spending. Now then later, obviously, you have your expansion phase. And in your expansion phase, you gather too much momentum, right? You are rising above potential. And this is obviously referred to as the boom phase, but it's probably best to sell your stocks and bonds before the slowdown kicks in. Because once the slowdown is going to happen, then your economy starts going down and you get back to potential, and then finally you get into a recession where you fall below the potential again, right? So that's where the recession comes. Now, this is a very nice exhibit from the curriculum which actually tells you what happens in the different phases with a description and how consumers and businesses respond in the different phases, what happens to employment, and these two are obviously linked, and then inflation, which is a lagging indicator. So let's talk about this, right? So first, recovery, your negative gap, negative output gap, which basically means your actual GDP is much less than your potential. So therefore, there is a negative output gap, but that starts to narrow, right? That starts to narrow. You start going back towards your potential, and then you get to your potential, right? And then you cross that potential, so you get into the positive output gap. So when you cross the potential, you move from recovery to expansion, and then you get into this positive output gap that you are going above potential. But then you peak at that gap between the actual GDP and the potential GDP, and then the rate of increase slows down, right? Your rate of actual increase slows down, and it becomes lesser than the actual long-term growth rate. So then basically you come back to your potential GDP again. And finally, you fall below potential GDP and the negative gap opens again. Now, when you're going through this entire cycle, what happens to your consumers and businesses? So, initially, obviously, the consumers and businesses, when you're at the bottom, at rock bottom, you realize that, oh, we need to hire those people back, right? And so, well, you stop firing people, first of all, so layoffs slow, right? So this is kind of a lagging indicator, right? Because already the recovery has started and people are still being fired. It's just that the speed of them being fired is slow. And then businesses move from using overtime to temporary employees, so they start hiring when you're already in the expansion. So this is lagging. But what is not lagging is the sales, right? So the minute the sales start to increase, the consumer spending, the business spending, that is something that which is a good indicator, right? It's not lagging. And your activity measures then obviously go above growth rates, and then finally obviously they start decelerating, and then eventually they go below potential. Whereas your unemployment, hiring starts in expansion, and even in the slowdown, unemployment rate continues to fall, which means you're still hiring, right? And you're already in the slowdown. So looking at the level of employment is probably not a very good way to try and predict the business cycle. And then finally, by the time you're having your layoffs, you're already deep in the contraction. So it's already too late to sell your stocks then if you try to time it looking at the employment levels. And the same goes for inflation. Inflation has a huge lag as well, right? So when you're in the recovery stage, inflation is still not going up, it's still moderate. In the expansion phase, when already it's in like reaching the peak, you're still like modestly going up in your inflation. By the time the inflation actually starts accelerating, it's already too late, right? The economy, it's already turned, it's going in the slowdown. So that's why I would like to emphasize on your activity levels, which I believe are probably one of the best indicators that you could monitor if you want to get in before the recovery starts and get out of the market before the slowdown starts. Right. So the behavior of businesses and household often leads uh, the turning points, right? And some parts of that might lag, such as your employees, right? So at the start of the expansion phase, businesses rely on overtime, and then they want to hire new employees, but then that part maybe has some lag. But the spending part doesn't have that much of a lag. So you need to have that appreciation for the difference between those two. Now comes the stock market behavior, right? So, as you probably expect, that at the start of the expansion phase, your stock price starts going up. And this in itself is the probably the best leading indicator that you could have, is that the stock market starts going up just before the recovery, right? And that's when you need to get in. And look at this, the equity markets actually hit that rock bottom 3 to 6 months before the economy hits the rock bottom. So this is probably the best leading indicator that you could find. And that's why, technical analysis is so important, and it's not covered in the CFA curriculum that much. Of course, we do cover it, but it's not like covered in a very detailed way. We as CFA are of course more focused on looking at the fundamentals such as business spending, consumer spending, and cash flows. But I mean, of course, we do cover technical analysis, and it is important because you need to see that, okay, fundamentally speaking, economic data is positive, business spending is increasing, consumer spending is increasing, and if the stock market is going up as well, that means you're definitely probably at that recovery phase. Now, by the time you get to the expansion phase, your market is already up, right? Your market is up, and your government is probably going to come in and start raising the interest rates and cutting down money supply. So the market doesn't like that. The stock market doesn't like that, and we probably are going to then start to roll over in our prices, and we probably would have already done that a few months before we hit the peak anyways, right? Because the stock market has a preceding trough and peak to the business cycle. And then the slowdown, so your assets will peak out over here, and I wouldn't wait for the slowdown to book my gains, right? But uh, it is possible that by the time your slowdown starts, your asset prices, some of them might still be going up because of just the momentum effect, and just the people who get in when the rally is just ending. So it's that last leg. But the safest bet would be to actually get out before this happens. You might lose that little bit last increase, but it's better to already have moved to secure assets such as government bonds before the price of government bonds go up. Right. So this is that entire rotation that you need to have down. And then the contraction phase, everybody moves into government securities, and people probably lose a lot of money in stocks during this. Right, so that is it for this first video on your business cycles. We're going to stop this one here, and in the next one, we'll pick it up with credit cycles and how that's linked with the business cycle.